Well, good morning, everyone. Today it's March 10th, and boy, oh boy, what a day yesterday. I mean, what a day yesterday. We're talking a day for the history books. Folks, before we get into the charts, I want to talk about something really important. We witnessed historic volatility. In just 1 week, let me look at the numbers here. The stock market lost $6 trillion in value, and the Dow Jones alone lost over 4,000 points. Yesterday's trading session was halted minutes after the opening because the S&P lost 7% at the opening. And it didn't fare so well during the entire session either. We closed near the lows. We're also approaching about 20% below peaks, which is bearish territory. Now, traders are hurting. There's no question about that. They're looking for a solution from this flash crash. We've seen good and we've seen bad in the economy, and now we're seeing the ugly. This was the quickest drop in the S&P since the 2008 Great Recession. But it's not the first time I've seen market activity like this, and it's not going to be the last. That's why this Thursday, I think less than about 48 hours from now, I'm going live, 1 p.m. Eastern Time. That's right, 1 p.m. Eastern Time on Thursday, and I'm going to show you exactly why these flash crashes offer us the best opportunities imaginable. I can't wait to share this with you. I mean, this is going to be really fun. I'm looking at the market right now. We're already rallying. This is really good. Now, this event could be the difference between blowing up your account and potentially earning up to 6 times your money. You don't want to miss it. Follow the link below. Now, let's talk about today's market action, all right? Let's get into it before I set you on your tone and on the way, before I set you on your way. All right, let's talk about today's market action. Let's get into it right now. Oh, what a day yesterday. Global stock market rebounded today. Today's Tuesday from record-setting declines after U.S. President Trump said he would ask Congress for a tax cut and other measures to ease the pain of the spreading coronavirus. But after reading that to you, I want to read something else to you. Central banks in the United States, China, and other countries have cut interest rates to try to shore up economic activity. But economists warn that while rate cuts might help buoy consumer demand, they cannot reopen factories that are closed due to quarantine or lack of workers and raw material. Did you get that? Very important. So this right here, tax cuts, all of these things, these tax cuts are not going to cause workers who've been sick from the coronavirus to get back to work. That's my point. If you're sick from the coronavirus, lowering rates is not going to help. It'll help the fiscal policy. It'll help create more inflow of capital, but it's not going to reopen factories, and that's what the markets are sagged about right now. All right. So again, Monday's global sell-off reflected alarm over economic damage from the coronavirus. Finally, the alarm bells are hitting off. Italy, not that good either. The hardest hit place in Europe. Travelers have been literally, it's really bad right now. But with that said, there is light at the end of the tunnel. Put to call ratio. The put-to-call ratio measures the amount of puts to calls in terms of sentiment. If you see investors buying a lot of puts, the market tends to turn around. If you see investors buying a lot of calls, the market tends to turn around. Typically, the number goes up to about 130, 140, it went up to 183. To show you the impact of that, or to show you how often that happens, not the impact, or, well, the impact too. That's the highest level we've seen since beginning of the year, end of last year, beginning of this year when we had a crash, and even further. I mean, this is as high as it goes. This is one of the highest historic levels. Let me see if I can go back 10 years. Couldn't even go further. Let's see if I can go back. I guess this thing doesn't allow you to go back further. I wanted to go to 2008, but I can't. But as you could see here, this is the highest level since 2010. So put to call ratio is telling us that puts have been really dominating this market, and that it's time for calls or for bulls to step in again. If you look at the S&P 500 chart, we are now at the support level, literally critical support level. If we break the 272 on the SPY, we're going to go down to all the way to 230. There's literally no support. There's a little support around 260, but quite honestly, if we break these levels, if we break lower, if we break down to here, there's a good chance we're going to go to the 233 level. That's not going to be pretty. But I do like the fact that put to call ratio is already at 183. That's telling us that we're fairly stretched out. Also, this is important, first time this year, these are my 10 sectors. Remember, technology has always been in the first spot with utilities neck and neck. Well, it's the first time since the beginning of the year that technology has come down and is now moving lower towards the consumer discretionary sector. And if that continues, there's a good chance the market will not be as fragmented as it's been or as stretched out as it's been. It's been just one big rubber band. Also, let me show you something else here. I want to show you momentum levels. I want to show you something really cool. If you go to the NASDAQ indexes, now we drew this. Notice now 24% of stocks are trading above the 200-day moving average. The number couldn't get below 50 for a while. Now, you see this circle right here? Let me change this. All right, I want to show you something cool. This is important. This is actually really important. We drew this circle about 2 weeks ago, and the momentum levels were right around here, around the 50th percentile, and every other fall we've had, even 2008. Let me show you this. Notice momentum levels goes down to about 20th percentile, 6th percentile, 2008. Again, 20th percentile, 20th percentile, 25th percentile, give or take. But in this case, we were stuck around 50th percentile, and that's when I had the video last week that said, I smell a rat, and the second video was, the second shoe has not dropped yet. And finally, momentum levels are in the 24th percentile in the NASDAQ 100, which tells me now that we are finally no longer overbought. And that coincides with what I'm seeing here. Utilities and consumer staples and healthcare, which are defensive sectors, are finally leading. Technology is still not below consumer discretionary or near consumer discretionary, but it's getting there. And that's telling us we're getting close. If you look, let me show you something interesting. If you were to look at the momentum levels, and folks, I've been following these momentum levels for years and years and years, and we were able to tell that a pullback or a correction was coming about 2 months ago based on these correction levels. Now, this is the S&P 500. This is the same chart. Notice it's been coming down. Yesterday, it actually went below, but everything here lined up. Even this lined up, got close to 25th percentile, 20th percentile, 20th percentile. 2008, we went all the way to 4th percentile. But notice yesterday, we went down below the 20th percentile. But the S&P actually reached down to this level and was in line, but the NASDAQ was not. Everything was in the 20th percentile or right here, which was below 20th percentile. But when we were looking at the NASDAQ was at the 50th. And I said till the NASDAQ drops lower, we're not going to see a full capitulation, and we finally saw it yesterday. And that's telling me that we are getting close to the bottom. We may not be there yet, but we're getting close. This is a very positive sign. So the fact that the stocks in the S&P 500 are finally coming out of being fragmented and stretched out, the fact that put-to-call ratio is now at 183, which is extremely bearish, and that the put-to-call ratio is finally now, that the percentage of stocks in the NASDAQ 100 is finally cooperating and is finally moving down, the second shoe drop basically, that tells me we are close to bottoming out. Also, we're near very medium-term support, very short to medium-term support levels to the downside. Let me show you a study here. I want to show you the RSI oscillator. And if you could see here, we've dropped the first time, and I said I want to see us go back into the oversold levels, and now we're there again. If you look, let me show you something interesting. Let me make this daily chart. Notice momentum levels, price levels are going lower, but momentum levels are not. We went lower, but price could not, the momentum level could not drop that level. That's telling us the indicator cannot sustain momentum levels this low. That's negative divergence, And that's showing me exactly the same thing that the S&P was showing me on the way up right here. Notice we go higher here, but we go lower on the oscillator. And now we're going lower on price, but we're going higher on the oscillator. That's momentum. And that's one of the most powerful ways to use the RSI oscillator. Again, notice here when the market tops out, we're going higher on price, but momentum, the highs on momentum levels cannot sustain themselves. And now notice we're going lower on price, but momentum levels cannot sustain themselves. That doesn't happen very often. That happens very infrequently, but it's happening now. That happens during turning points. And that's everything I'm looking at right now. The put to call ratio, the momentum levels, the divergence in the RSI, the lack of fragmentation or less fragmentation in the sectors is telling me that this market is going to turn around very, very, very soon. And that's why you don't want to miss my class Thursday, about 48 hours from now, maybe less than 48 hours from now. It's happening at 1 p.m. Eastern time. You don't want to miss it. Again, folks, we've seen the good, we've seen the bad in the economy. This was very, very ugly, but there's a way to profit from this. There's a way to profit from this. There's no reason to lose more money from this. So this event literally can be the difference between blowing up an account and potentially earning 6 times your money. You don't want to miss this. This is an amazing, 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 amazing opportunity. Folks, we have systems during this crash. We have positions that are up 300 something percent, 350%. We have positions that are up 250%. We have one trading account that's up 70% after this crash, and the other one is up 34% just in the last 2 weeks. You really don't want to miss this class. If you want to turn a crash into something better, if you want to turn this into a opportunity to learn and profit, all right? Turn your flash crash into fast cash. All right? Thursday, 1 p.m. Eastern time. Do not miss this. This is going to be a historic event. I'm going to change your life. I've predicted this correction a month and a half from now. If you don't believe me, just look at my videos. And it finally happened. Every day I've been telling you how the market was overbought. Well, I'm now expecting something totally different. All right? It's a reversal of fortunes. It's happening this Thursday, 1 p.m. Eastern time. Flash crash into fast cash. You don't want to miss it. 1 p.m. Eastern time. Be there or be square. Talk to you guys soon. Be careful out there. Stay safe.